Welcome to Revision Session 3. Now I put this one together specifically for some candidates who are sitting the exam next week, and they wanted me to cover interest rate options and how they work and a couple of questions on rates. So we'll start off with interest rate options, quick question on money market terminology and the importance of listening to see whether you're a price maker or price taker. We'll have a quick look at delta hedging. Option structures cover strangles and straddles in this case. And finally, there's a question on hedging with forward rate agreements. Let's get the ball underway with caps and floors. Now, consider you set up a trading strategy today for 5 years with the following positions. You sell a cap, so you're selling a cap on Euribor with a strike of 1.2% with quarterly observations in advance, and for the cap you're selling, you're going to earn a premium of 80 basis points. Now remember, if you sell a cap, somebody is buying protection from you if rates go above 1.2%. If they stay below 1.2%, the strike's not excised, the cap's not excised, you get to keep the premium. That's the first part of the trade. On the second part, you buy a floor on 3-month Euribor with a strike of 40 basis points with quarterly observations in advance. The premium you pay, because you're buying the floor, is 55 basis points. Now remember, if you buy a floor, you will be compensated if rates go below or set below 40 basis points. Assuming that 3-month Euribor will always set within a range of 40 basis points up to 120 during the life of this strategy, what could be the maximum positive result as a percentage of bullet notional that can be achieved by this strategy? So think about it. You're earning 80 basis points, you're spending 55 basis points, that's a net premium of 25 basis points. Will the cap be exercised? No, rates aren't going to go above 120. Will the floor be exercised? No, rates won't go below 40 basis points. So the answer here is going to be a net premium to you of 25 basis points. So think about this. I've drawn it out so it's easy to understand. This is the first part of it. You're selling the cap, so you pay if rates rise higher than 120, but for selling the cap, you're going to earn a premium of 80 basis points. On the other side, you buy a floor at 40 basis points, which means you will receive if rates fall below 40 basis points. Now, there's no such thing as a free option, so you're going to have to pay for that floor, and it says you're paying 55 basis points for the floor. So a net premium of 25 basis points. Now, as you can see with the green line here, Euribor stays within the range, so neither the cap nor the floor are exercised. You get to keep the whole net premium of 25 basis points. Quick question here on money market terminology, just to show the importance of thinking about what's happening to the cash and figuring out if you're a price maker or price taker. It starts off 2 keywords. You quote your customer. 4 keywords. You quote your customer, so you're a price maker. You quote them a price of 0.75% to 0.8% for a 1-month dollar deposit, and the customer says 20 yours. What have you done? Well, when they say yours, they're saying yours is the cash. I'll hand over the cash to you. So this is the customer on the left here. They're handing over cash to you, the bank, yours, $20 million worth. Now, if they deposit cash with us, we're going to have to pay them interest. How much interest will we pay? As little as possible. So we're bidding the cash off the client, and in return we will pay them 75 basis points. So we have borrowed the cash, haven't we? The cash has come into the bank, and on that cash we're going to pay 75 basis points. So yours would be when they're giving us the cash. Mine, if they said 20 mine, would be where they're borrowing the cash at 80 basis points. But in this question, they're saying yours. This is where the cash is going to. An overnight deposit of $20 million is made on Friday at 15 basis points, then is rolled on Monday at 10 basis points, on Tuesday at 9 basis points, on Wednesday at 11 basis points, and on Thursday at 12 basis points. How much is repaid on the following Friday? Now, first thing to point out, when they leave you the money on Friday at 15 basis points, they're going to earn that 15 basis points interest for 3 days, for the Friday, Saturday and Sunday. Then you'll have the daily rolls, Monday, Tuesday, Wednesday, and so on. This is what you're going to see when you look at overnight index swaps. So what we're looking at is what is the principal and interest that's accumulated, that's compounded by the following Friday in a week's time. Now I'll tell you the answer and show you two different ways to calculate it. The answer, and you can figure it out for yourself if you put me on pause, is the first one, $20,483.34. Now there are two ways. This is also a question which highlights the importance of knowing how your calculator works and how the memories work. Let's look at it the long way. Wow, a lot of numbers here. So this is our starting point on the top left. We're starting with $20 million. What will be the principal and interest in 3 days' time? Well, multiply it by 1 plus your interest rate, which we know is 15 basis points, written down as 0.0015, times 3 over 360, times 3 days, Friday, Saturday, Sunday, and it's dollars, so it's actually over 360. So after 3 days, your principal and interest would have gone up by $250. What you're now going to do is reinvest that for another day. So on the Monday, you're going to earn 10 basis points. So your principal times 1 plus your 10 basis points times 1 over 360 means with the day's interest, you've gone from $250 growth in your money to $305.56. You do exactly the same for each day of the week with the respective interest rates. And of course, you're just doing that daily, 1 over 360, 1 over 360. But at the end of the week, your principal and interest is compounded up to you being $483 richer. That's one way to do it. Another way to do it is this, and this looks pretty horrible, but it's actually logical. On the top left, you've got a 15 basis points. Multiply that by your 3 days, your Friday, Saturday, Sunday, over 360. Once you've done that, add it to 1. So this number here, if you multiply that by your 20 million investment, would give you your principal and interest after 3 days. So what I want you to do is store that in your first memory. So when you look at your keyboard on your calculator, imagine it's like a load of cardboard boxes. Each cardboard box is numbered 1, 2, 3, 4, 5, 6, 7, 8, 9. And you're going to store it, in this case, in the first box, store 1. What you're going to do then is work out what would be the principal and interest growth for 1 day's interest if you earn 10 basis points, which is what Monday is offering. Well, 0.001, 10 basis points, 0.1%. Now I've divided it by 360. What I could have done is said multiply by 1 over 360. It would give you the same thing. Work that out, then again add it to 1. So what this number here is representing is what your principal and interest would grow by if you left it in the market for 1 day. What I want to do is store that into your second memory. We do the same with the third, fourth and fifth data points. Now what we're going to do is you're going to recall these numbers from your memories by pressing RCL. So RCL is short for recall. So we're going to recall the number for day 1, well, period 1, times recall for period 2, times recall 3, times recall 4, times recall 5. And you get this number here. If you multiply that by your original $20 million investment, it will give you the same number. It's showing you the compounding effect of having your principal and interest rolled over on a daily basis. You need to know this because this is important when we come to overnight index swaps where you have daily compounding. Right, delta hedging. Sounds technical. Let's see how bad it is. You have sold a European style at the money forward, $7.5 million dollar put yen call with a strike of 150.5 and maturing in 6 months. Well, that's a load of information to take in. Let's just think about what we've done. If you've sold an option, okay, so we sold somebody a European style option. So if you remember, European style is where you have the right to exercise the option just once. It's struck at the money forward. Now, if you remember, when an option is struck at the money forward, it has a delta of 0.5. If you're long a call option, it's a plus 0.5 delta. If it's a put option or if you sold a call option, it's minus 0.5. Well, what does delta actually mean? What it means is that for every 1% move up and down in the underlying, shows us the percentage by which the option will move. So if your underlying moves up in value by $10, a 50 delta option will move up in value by $5 or 0.5. So whether you call it 50 delta or 0.5 means the same thing. Now you've sold a $7.5 million put option yen call with a strike of 150. So that means that you've given somebody the right to give you $1 and receive at least 150.5 yen. So if the yen strengthened and went down to 140, 130, 120, they would exercise the option. Now you want the position to be delta neutral. What's the most appropriate spot deal to hedge your position? Well, we know the overall deal is 7.5 million. So 50 delta would be half of that. So that would be 3,750,000. So it can't be answer B, and it can't be answer C. It's got to be A or D. Now, if you've sold the option, it's a negative delta number, minus 0.5. So the answer here would be go to short dollars, sell $3,750,000, sell half of the notional amount. So by way of revision notes, I put here put option has a negative delta. So an at the money forward strike has a delta of minus 0.5. So 7.5 million times minus 0.5 means you go short $3,750,000. And here we put the thought process. So if you sold a dollar put, the option will lose you money if the dollar depreciates. In our example, it's not earning you so many yen. So if it's causing you pain by depreciating, you need to buy something that's going to counteract that and give you a bit of pleasure if the dollar depreciates. So if you go short the dollars, you'll benefit if the dollar goes down. So the loss on your option trade is being offset by going short the dollars on the other hand. So one offsets the other. That's hedging. Okay, quick look at a strangle here. A client simultaneously sells a call on oil at $90 a barrel. So let's just think about that. They've given somebody the right to buy oil off us at $90 a barrel. So if the market price is 95, 100, 105, it's not the customer's problem. They've got the right to buy it off us at $90 a barrel. And the client sells a put at the same time on oil at $80 a barrel. So by selling a put on oil at $80 a barrel, that means that somebody can come along to the client and say, listen, I know oil is $75, $70, $65, whatever in the market, but you sold me a put which gives me the right to sell it to you at $80 a barrel for the same period. So just to be clear, the client has sold a call, so they're going to be in pain if oil goes above $90 a barrel, and they sold a put at 80, so they'll be in pain if oil goes below $80 a barrel. Now, what would you describe this strategy as? This is a short strangle. I don't know who thinks these names up. So let's just see what the story is with a strangle. A strangle is when you sell both a call and a put. If you go on a short strangle, when you sell a call and a put at different strikes. A straddle is where you'd sell a call and a put at the same strike, typically at the money forward. A strangle is a more conservative thing where you sell a call and sell a put at strikes which are slightly away from at the money forward. So this red line I've just drawn down, that would be at the money. By selling a call here at 90, they're selling it out of the money. By selling a put at 80, they're again selling it out of the money. Here the at the money would be probably around sort of 85. Now by selling the options slightly out of the money, they won't earn so much premium because there's not so much intrinsic value, but at least they won't lose money for a little bit. The market has to move a little bit before they lose money. If you look on the right hand side, you can see by selling a call, they're going to be losing money once the price of oil goes up over a certain level, and if oil goes down below a certain level where they sold a put, they're going to lose money as well. If, however, oil stays within the range between $80 and $90 a barrel, neither the call nor the put will be exercised, so the client gets to keep the premium from the two options that they've sold. So what you're doing is by going on a short strangle, you don't want the markets to be too volatile. If they're less volatile, the price of oil is unlikely to move either side, so you get to keep the premium. That's a short strangle. Synthetics. Now, synthetics is one of those words in financial markets that makes it sound more difficult than it really is. Now, have a look at this. The sale of a put and the purchase of a call with the same nominal amount, strike and maturity create what? Is it a collar, a straddle, a strangle, or a synthetic long position in the underlying asset? Well, it's not a collar because With a collar, you buy a call, sell a put, or vice versa. So it's not that. Here, you've sold a put and bought a call with the same nominal amount. A collar is normally where the strikes will be different. It's not a straddle. That's where you buy a call and buy a put at the same strike, at the money forward typically, or it's where you sell a call and sell a put again at the same strike. It's not that. It's not a strangle. We looked at a strangle just now. It is in fact a synthetic long position in the underlying asset. What on earth does that mean in English? When you hear the word synthetic, you immediately think it's more difficult than it really is. Think about this. If you go short a put, if you sell a put option, you're going to earn some premium, which is great. However, if the market price goes down in the underlying asset you sold the put on, you're going to lose money, you're going to pay out. So it'll hurt you if the prices go down. At the same time, you've gone long a call option. Now, if you bought a call option, if you've gone long, you're going to have to pay premium. But if the underlying price goes up, hopefully you'll make enough money to recover that. So what do you have in life what's the position in everyday life where if the price goes up, you're happy, if the price goes down, you're unhappy? That's just owning something, owning any asset. So that's why you have a long position. If you have a long position in something, you make money when the price goes up, you lose money when the price goes down. And you've created exactly the same effect of ownership by going short a put and long a call. So if they're done with the same amount, same strike, same maturity, that's a synthetic long position. It's just, don't get freaked out by the word synthetic. Delta hedging. How would you delta hedge an at the money long call option? Now we've already said if an option is at the money, that's a 50 delta option, 0.5. And if it's a long call option, it's plus 0.5. So what are we going to do here? Well, if it's a plus 0.5 delta option, it can't be answer C, it can't be answer D. You're not going to go short or long of the underlying equal to the full size of the contract. It's going to be to 50%, 0.5 of the contract. Now the answer here is to go short of the underlying commodity equal to 50%. If you're long a call option, if the price of the underlying commodity goes up, you're a winner. Great, you've got a call option on it. But if the price goes down, you're losing money. So what you need to do is to put a trade on the books which will benefit you if the price of the underlying goes down. So that's why you're going to go short of the underlying commodity. And as you remember, if you go short on something, you make money when it goes down. So if the price goes up, the option will make you money. If the price goes down, the short position will also make you money. So you're hedged. What I've done in the notes again here is you can see the wording basically of what I've just said. Another point I want to point out is it says when an option has a delta of 0.5, that's the relationship of the movement in the option value to a movement in the underlying. So again, if the underlying goes up in value by $10, then the optional price will move up in value by $5, 0.5%. Sorry, 50%, 0.5 delta. Weighted average rates. This is applicable if you're running money market positions and you want to see the average cost of your funding or the average cost of your loans. You take in 10 million euros at 3.5%, 5 million euros at 3.4%, and 5 million euros at 3.6%. What is the average rate on your position? Well, just look at the weightings. It's all relative. It's like ratios. So if you've got 10 at 350, just multiply one by the other, you get 35. We've got 5 at 340, so 5 units at 340 gives us 17, and 5 units at 360, add it up, and you get 35 plus 17 plus 18. Divide that by 20 because we had in all 20 million euros, and your average cost there is 3.5%. It's just ratios, it's just averaging, it's really not difficult. Hedging with FRAs. Now you've made a forward loan for 3 months starting in 6 months' time. Okay, just look at that sentence once again. If it's a forward loan, it's a loan starting at a future point in time, ending at a future point in time. When's the starting point? 6 months from today. How long is the loan going to go for? For 3 months. So the period of time we're looking at is a period of time starting 6 months from today, ending 9 months from today. So 6's nines, we're identifying that 3-month block of time starting 6 months from today, ending 9 months from today. What would be the best hedge for this position? Now, if you've made a forward loan, you've locked in the rate of interest you're going to earn on that loan. But we don't know the rate of interest we're going to have to pay for our deposits to fund that loan. And the worst thing that could happen is interest rates go through the roof and it costs us a lot more to fund that loan than we really anticipated. So as a borrower of funds, which is what we're going to be when we take in the deposit, we want to protect ourselves against rates rising. What do borrowers do in the FRA markets? Borrower buys an FRA. So the period of time we're looking at is 6's nines, so it can't be that. And we're not buying the nearest futures contract. So what we're going to do is we're going to buy a 6's nines FRA in an amount equal to the notional loan value. So 6's nines is a period under discussion. And if you look at this answer A, borrowing 3 months and lending 6 months, that's the wrong period altogether. It can't be A. So you could actually work this out by seeing which answer it's not, as well as which answer it is. Let's look at it graphically. What I've done at the bottom is I've drawn out the lines. So this is us here today, times 0. The period under discussion is a period starting 6 months from today, ending 9 months from today. Now let's just say I'd locked in a rate on the loan, on the money I'm lending, and I'm going to earn 5%. What I don't want to happen is that when I come to pay for the deposit to fund that loan, that rates have gone above 5% because I'm paying out more on my deposit than I'm earning. So how do you get paid out under an FRA if rates go up? You buy the FRA. So buy the FRA for the period starting 6 months from today, ending 9 months from today. This is why it has to be answer D. Final point, straddles. Now I'm going to show you something just before we go into the actual question. If you remember, if you go long a straddle, if you buy a straddle, what are you doing? You buy a call option, strike A. So if you buy a call option, this is a typical profile in red you can see on a call option, but of course by buying the option, you're going to have to pay premium for it. So you buy a call option, but if prices rise, you will benefit. What you're also going to do is you're going to buy a put option. Now again, that's going to cost you premium, so it's quite an expensive structure because you're paying for 2 options, but by buying a put option, you're going to benefit if prices go down. Why would you do this? You would do this because you know something's going to happen in the market, but you're not quite sure what. You don't know if the market's going to go up or down, you just know something's going to happen. So to benefit from both scenarios, you buy a call and you buy a put. So if the market goes up or goes down, you're a winner. However, because you've spent money on 2 options, it's expensive, so the market's going to have to move quite a way to pay you back, to break even, to cover you for the premium on the 2 options that you bought. So that is a long straddle, where you buy a call, buy a put at the same strike, and that strike is normally the at the money forward rate for the underlying. So on the left, there's the long straddle that I've just described. On the right is a short straddle. Now this is where you don't think something's going to happen. So you sell a call and you sell a put, again at the same strike. Now if you're right and nothing happens, if the market just stays in a range, you get paid because neither the call nor the put are exercised, so you get to keep the premium from the 2 options you've sold. So what you want to do is to sell the call and the put, and if volatility goes down, you're a big winner because you sold when volatility is high, you got paid more for that option than you probably deserve. Volatility goes down, great, well played. Now that takes us into the question, what is the purpose of a short option strategy? Why would you do a short straddle? Okay, here we are. Answer A, to anticipate low volatility in the price of the underlying commodity. If you buy an option when volatility, or sell an option when volatility is high, you're going to get paid a lot of money. The next day, if volatility goes right down, you'll think, wow, it's a good job I sold the options yesterday. Since volatility's gone down, that option wouldn't be able to sell it for such a high price in the market now. So this is why you go short on the option, because you anticipate low volatility in the price of the underlying commodity. Right, that brings us to the end of the questions. Bit of a variety there. Hope you found it useful. Just remember, pause the questions, go through them again, and don't be put off by terminology. And the other key takeaway we learnt is to know how your calculator works. Understand the memories, the store function and the recall function. It'll make your life so much easier. Thanks. See you next time.